Okay, so today we're going to be talking about gold. So gold, this chart, I want you to ignore this right now. I want you to ignore this surge up higher, and I want you to focus on the price action on the left. So you can see during this time, during this leg lower, we were clearly operating within a bearish market structure. See how we were consistently putting in lower lows, consistently putting in lower highs, trending lower consistently. So we were operating within a bearish market structure. Now on Friday, it's Saturday at the time that I'm making this video. So yesterday, I posted this in the free Discord chat as a buy play, as a buy setup. Okay, so, which begs the question: why did you post a buy setup whenever the 4-hour higher time frame market structure is bearish, Mike? Why did you do that? Why are you fighting the trend, Mike? Well, again, utilizing the tips that I've given you in previous videos, we're going to really be nailing it down for good in this video. We're going to break it down. So again, something could be in one bearish market, could be in a bearish market structure on one time frame, but bullish on another. Okay, and then by utilizing other tools like premium and discount, we can capitalize on these short-term price movements, these short-term fluctuations in price. So 4-hour market structure was bearish at the time that I posted this. Okay, so here's what we're going to do. We're going to take a Fibonacci from this high to this low, because that was the last leg lower when I found the play. Okay, what we're going to do is we're going to mark 50% equilibrium of that price range. See that? Bearish market structure, but it's in a discount. Remember, this is bearish market structure consistently trending lower, but it's in a discount marketplace. What does discount mean, guys? Discount means cheap. Premium means expensive, and anything beneath this equilibrium price point is cheap. Anything above it is expensive. So by utilizing lower time frame market structure, we can find that switch in market structure, that change in trend, while it's in a discount marketplace to take it back up into a premium. You don't want to be buying anything in a premium. Don't do it, because it's expensive at that point. You need to be looking for if anything, you need to be looking for PTs in a premium, taking profits, getting out of the marketplace, because it is bearish at the moment. This trend down here is bearish. So you are technically fighting that higher time frame trend, which isn't ideal. Okay, that's not how I personally trade, or at least at the time that I'm making this video. I can't forecast the future, but I do this to give you guys other examples of ways that you can trade. Also, it makes for a very good market structure lesson, because market structure, as I said in the beginning of the video, you can be bearish on one but bullish on another, and that's what we're going to be breaking down. So we are in a discount marketplace on this move down right here, bearish market structure. Now our job is to see, we're gonna see it where it had that shift, where it switched to bullish market structure in a discount marketplace. And once you're able to identify that, you can capitalize on higher prices. All right, look at this. I want you to identify. Now we're on a 1-hour chart. We were on the 4-hour chart, and we concluded that the 4-hour market structure was bearish. We concluded that we're in a discount already. Okay, and we're in a discount while we're underneath of this green line, this green horizontal line. Anything above that green horizontal line is a premium marketplace. Okay, so I want you to identify for me down here in this price action, identify for me where was the shift and where was it 100% confirmed. All right, I want you to take a moment and do that. All right, ready? If you need more time, you know what to do. So right here is where we had that shift. I'm going to put a little trend line in right there. See how we broke that swing high right there on that surge up higher? That was our shift in market structure in a discount marketplace on the 4-hour chart, in a cheap marketplace. Discount means cheap, remember. Okay, 4 hours bearish, 1 hour just had a bullish shift in a discount. That's key. Now, it was also, would this be a high probability shift? Answer among yourselves. Would that be considered a high probability shift, considering what I've taught you thus far in previous lessons? Abso-freaking-lutely, that would be a high probability shift. Why is it a high probability shift? What's the criteria for a high probability shift? What did I tell you? Well, the shifts where you have price making a new low like this it's taking out lows, and then right after it takes out that low, it breaks the previous high prior to making that low. Whenever it has that criteria, that type of market structure shift, that's ideal. That's what you want to see whenever you have that type of shift. But also the fact that we have the fair value gap confirmation in there. See that? 1, 2, 3. 3 candles, the top of the first, the bottom of the third, they do not touch, leaving nothing but a fair value gap in there. That is a imbalance. Okay, it's good to see that imbalance created on the breakage structure. It makes it a high probability shift. That means there is a lot of interest in that particular area. Also note how it was a strong close above that level. See how the candle closed above that level? Now we have all three. We have all three of the criteria making that high probability shift right there. 1, 2, 3. Everything you want for a high probability shift is right there, and it's in a discount marketplace on the 4-hour chart. What is price? But it's not 100% confirmed. If you want to be aggressive, you could grab that pullback down into a discount, which is what I'll do many times for my particular strategy. A lot of times I'll just grab that first shift lower, anticipating that the price swing is going to get formed if it's got like a really nice shift and it's off of a higher time frame level. But in this case, so you could catch that move lower right there if you wanted to be more aggressive. And what could you do? Like how would you play something like this? How would you play the market structure? So this is a really good lesson here as for like where to keep your stops whenever you're playing market structure. The best place to keep your stop is going to be underneath of the low prior to the shift. You can go with the fair value gap low if you want, but it is a little bit more aggressive. The safest bet, and if you're a beginner, this is your best bet to do this. All right. So if you're just a complete beginner, I recommend staying away from the low of the fair value gap, which in this case, it's basically is the low, but go with the low, the absolute low prior to the shift, which is right here. This was the absolute low that price hit prior to that shift. Once price comes down into a discount, you're going to look to get a buy, and you're going to keep your stop beneath that absolute low. If price was to break that absolute low at where my cursor is moving, if it was to break at that point, that market structure right there would be invalidated. You would be proven wrong, and that is fine. That's fine. But the point is, you want to put your stop at a point where the market structure is invalidated. That's the key. A lot of people, they don't do that. A lot of people, they strangle their play for the sake of precision, for the sake of keeping a tight stop loss. They're more focused on playing their stops, and they're not focused on the actual market structure that is in front of them. Place your stop at a point where, when wrong, the market structure would be invalidated. If it broke that low, the low that is the low prior to making that shift, if that low was broken, that market structure would be invalidated, and you were wrong. And that's fine. But that's how you need to do it. There's nothing wrong with being precise. There's nothing wrong with, getting tight, good risk reward plays like this would be. If you were to grab it down into the discount, risk that low, and look for objectives up here in a premium, that is amazing risk reward, and you're playing the market structure at the same time. That is the way to do it. That is how you keep your stops at good points. Okay, so stop underneath that low. You could have grabbed that first move. If you want to be absolutely safe, you could wait for market structure to be 100% confirmed. What is the criteria for market structure to be 100% confirmed? Can you guys tell me? We want a swing low put in, just like we done on just like when we first started these lessons on market structure. We want to see the shift, and then we want to see a swing low. It's the same deal on a lower time frame chart because price is fractal. It's the same signatures. We break that high, we pull back, which is step number 2, and then we put in a swing low. That's confirmed. It's lowest low in the middle, higher low on the right, higher low on the left. It is 100% confirmed once that candle closes right there on the 1-hour chart. Remember, you need that candle to close. It closes, that 3 o'clock 1-hour candle closes. We come right here. Confirmed. It is 100% confirmed, and it's still in a discount marketplace. See that? See how it's still below that equilibrium price point in the 4-hour chart? So what is the story now? Well, what did I tell you guys at the beginning of this video? You can be in bearish market structure on one time frame, but you can be in bullish market structure on another time frame. This is a clear representation of that. We were bearish on the 4-hour, and now the 1-hour is 100% confirmed. The 1-hour is completely confirmed bullish in a discount marketplace on the 4-hour. There's opportunity in that. That's where that inefficiency in price lies. When you're bullish on one, but you're bearish on another, and that is how you counter trend trade that successfully, is by capitalizing on that short-term trend, that short-term change in trend. Okay, high probability shift, swing low put in, confirmed. You could look for a long in here. during this little consolidation period, you could look for a long if that's your thing. And then you could get on board that price up higher, or you can maybe utilize like a different time frame. Look for opportunities on the different time frame during that little pocket of price action right in here. Like right in here, we see it taking these sell stops. Maybe that was your entry to come down, take those sell stops into that level of support, into that little bullish fair value gap imbalance right there on the 15-minute. See that? If you want to go even farther, I don't go down even to, I don't go lower than a 15-minute, but if you want to, you can. That's what I want to get you guys to do. I want you to experiment around in your chart and find what works for you. If you like going lower than a 15-minute, by all means, find what fits you. I just find like it gets a little bit more noisy when you go below a 15-minute. I find the higher time frame charts, they're just cleaner, easier to read, less fake outs. But if you want to, experiment around with it, and you could get on board this lower time frame trend to take up into a premium. The next question is, all right, but what about PT though? All right, we confirmed, like we know where to get in for an entry. We've already confirmed that over here. We confirmed where to keep our stop underneath of the absolute low prior to the shift. That's always going to be the best place to keep your stop. Whatever play it is, it's going to be the low prior to that move up higher, the absolute swing point, the absolute low of that high probability shift. That will always be the best place to keep your stop. That's when you want to put in the notes. You want to have it by you at all times. All right, so but what about for PT though? After we got our entry in a discount marketplace, what about for a PT? Well, for a PT, so again, PT is going to vary because we all have different styles. Some people are more aggressive, some people are more conservative. I mean, really, if you wanted to, you could just, like literally, you could just take profits at this high. So you got in on this pullback in a discount, you could take profits at that high, because once it takes out that high, it is in a 15-minute premium at that point. All right, don't get lost there with what I said. I said 15-minute premium. I know some of you are looking at this and you're thinking, whoa, hold up, Mike, it's in a discount. You just said it's in a discount on right here. It's at a discount on the 4 hour, but if it was to, once it comes up and it takes out this high right here on the surge up, the 15-minute is in a premium marketplace. It's in a premium marketplace at that point. So it's short-term expensive, and knowing that, you could just take profits or maybe take a partial once it takes out that high, hold out for higher objectives later. Or you could take everything off there. Like it's really up to you at that high right there. But yeah, so we could be in a premium on one time frame, but in a discount on another. Like take out that high, you're in a 15-minute premium, but you're still in a 4-hour discount. You're still cheap on the 4-hour chart. Price does what? It comes down, it takes out this swing low level, taps into that fair value gap. I consider that a discount. Now, this is one that I don't talk about too much in other videos, but one way to measure premium and discount is below 50% of the price range. But also, once you take out a swing low level like that, once you take out sell side liquidity like that, that's a discount. And then you combine the fact that you had the fair value gap in there, that's a discount. Absolutely. So we come down to a discount right there. We take those sell stops, we're back down cheap, and it rips up. If you want to be a bit more aggressive, but still it's a reasonable PT area, is you need to look this. Remember, this is our equilibrium price point. Anything above it is expensive in a premium. What you could do next is you can look in a premium and identify that next key liquidity pool in a premium marketplace for your PT, which is likely going to reach. So go to a 4-hour chart. We're going to start here. And I want you to notice what we got right here. What is that? What did I just mark? Take a moment and answer among yourselves. What did I just mark? I marked a fair value gap, a bearish fair value gap that was created on that move lower. Because remember, 4-hour market structure is bearish in here, and we had this move lower right here, creating this little fair value gap in a premium marketplace. So that could be a PT for you, because that is that next major area in a premium marketplace. Once we come up and we completely rebalance that price action in a premium, you could just exit, be content, take your profits there. Whenever you're counter trend trading and your higher time frame trend is in the opposing direction of your position, you want to be conservative. You want to be conservative with your PTs. Okay, you could be a bit more aggressive if you want to. If you're trading with the overall higher time frame trend, you can afford to be more aggressive. But I'm telling you, I know I say everybody's got their own styles. Do your thing. This is one of those things that you need to be conservative if you're fighting the trend. Okay, being aggressive while fighting the trend, looking for home runs, that's not a recipe for success. Okay, again, everybody has their own styles, but there are some things that are, they're kind of set in stone. All right, you're going to have a hard time getting any home runs looking for the thing just to rip up to the moon. Whenever you're fighting a higher time frame trend, you're going to get tagged over and over and over again. Take partials if you want to, or take everything at one point, but you need to be more conservative whenever you're fighting the trend. Okay, but this is how you do it, guys. That's how you can be fighting the market structure on one time frame, but you can still capitalize and make money. All right, and if you look at several different pairs, like 7 different currency pairs, you'll get opportunities like this often, where you'll have these, like you'll have the market structure on one time frame, but then you'll have a clear different trend on another time frame, and you can capitalize on that. There's opportunities to make money in that. There's plenty of people that trade like this to make money consistently. The only question is, does it fit you? Do you like that style, or do you like to trade with the overall trend? You got to experiment. You see what works for you, but that's how you do it, and that's how you do it successfully.